Welcome to the Chesalbridge Capital Market Observations Call for Friday, May the 5th, 2023. I'm your host, Eric Jefferson. I want to first and foremost wish everybody a happy Cinco de Mayo as well. I want to spend a couple minutes talking through some of the events that took place earlier this week. Heard from Chair Jerome Powell with respect to interest rates. We'll interpret some of his remarks as well, provide some thoughts where we think we may go from here. Now, before we get started, have a few quick words from our legal team. With that, we can go ahead, dive right in. And as expected, on Wednesday, Powell announced yet again an additional 25 basis point interest rate hike. That now caps off, going back over the last 14 months, now 500 basis points or 5% increase in interest rates. Current levels, now the highest they've been going back over the last 16 years. Now, in his commentary afterwards, Powell insisted no decision to pause additional rate hikes had been made. However, as we interpret some of the very subtle, nuanced shift in the language or verbiage in his prepared statement, interpretation suggests they likely are in fact done hiking. That was something very similar to how the Fed communicated their intentions to do so back in 2006. Now, Powell's official stance does certainly leave the door open for additional hikes if inflation does remain stubbornly elevated. However, some historical context suggests that's very unlikely. No Fed since 1960 has continued to hike after we've seen a peak in core inflation. Again, never say never, but with some softening economic data, I think it's very unlikely to see rates move past their current levels. Now, while this was highly anticipated, you did see the market breathe a collective sigh of relief. Unfortunately, no celebration ensued, similar to a surgeon after a very long procedure. Now we need to hurry up and wait to really digest the impacts of what has been one of the fastest interest rate hikes in recent history. Now, in the past, cumulative hikes north of 300 basis points or 3% have ended in recession. That's even before you consider a banking sector currently under some pressure. Now, as we look to the balance of this year, interestingly enough, Powell very quickly dismissed the notion of any rate cuts, cited the strength of regional banks, the overall resistance of the economy. And that remains in sharp contrast to the bond market. The bond market for some time has been anticipating or suggesting a fairly severe recession will ensue. And as a result, they are starting to price in 75 basis points of rate cuts between now and the end of December. Ultimately, I think history will determine who is correct there. But given all of the uncertainty around economic growth, the U.S. debt ceiling, whose timetable has now been moved up, as well with regional bank stability, I think it's very likely volatility will remain elevated over the short term. Good news, though, from a macro standpoint, once we do navigate several of these issues, do believe on the intermediate and then again on the long term, should see global risk appetite once again improve. Now, that's all for today. As always, happy to discuss anything in more detail. If we don't connect, have a great weekend. Take care.